Google just changed the game. They raised $85 billion in equity, and this news totally shook the market. Hi, my name is Victor, and today we're going to take a look at what happened to the markets over the last couple of days. So, Google just did an $85 billion public offering, and $10 billion of that is being bought by Berkshire Hathaway at around $350 a share. And there are two ways to read that, so let me give you the bad and the good. First, the bad. That 350 is below where the stock is trading. So Google basically handed Berkshire a discount. You can read it as a slightly bearish tale. Like they needed to dangle a cheaper price to lock in a big anchor buyer. But here's the good. And to me, it outweighs it. It's Berkshire. This is the most patient, value-focused money on the planet. A firm sitting on a record pile of cash because they think almost nothing is worth buying. They rarely touch fresh stock offerings, and they've historically avoided expensive tech. So for them to put 10 billion into Google's race is about as strong of a vote of a confidence as you'll get. One quick disclaimer though, Buffett doesn't actually run Berkshire day-to-day anymore. Greg Abel does now, so this is a new era, like a new era for Berkshire. And it's not literally Warren's personal stock pick like it would have been a few years ago. But still, that's Berkshire. The whole institution is built on not overpaying for the companies they buy. And they chose to buy Google. They chose it. And this stuff actually, I think this stuff carries weight. The moment the news hit, Google stock dumped, and so did every other hyperscaler. The market's read was basically, this is the end. Now every hyperscaler is going to dump shares on us. And it thinks more because Google has great debt ratios. They could easily have just borrowed the money. So why issue stock? Why dump shares on us? And a lot of people think it's because we're in late stages of the bull market. There's euphoria, and Google doesn't actually believe it's worth $375 a share. So they sell stock to us while the price is high. Pretty simple. And remember, SpaceX is going to IPO soon. OpenAI might IPO. Anthropic might IPO. So there's a battle for liquidity. Google might want to be first, grab the cash from us, retail investors, before everyone else lines up to do the same. So let's actually look at what Google has to say. Google's counter-argument is that AI demand is enormous, and notice they mostly point to their own internal AI. Let me just read this. 2 years ago, we processed 9.7 trillion tokens a month. Today, that number is 3.2 quadrillion. That is insane amount of growth. I think it's roughly 300,000x jump. Yeah. There are some other stats too. Revenue from products built on their Gen AI model is up about 800% year on year. 2.5 billion monthly users of AI overviews in search. Okay, I mean everybody uses search, so that one's less impressive. 8.5 million developers building on Google's model every month. Also nothing special. And they have about $174 billion in operating cash flow. So the 85 billion they raised is only about half of 1 year's cash flow, which is a good argument actually. So the real question is the demand actually that great? My take, yes, Google Cloud revenue is growing 63% year over year, which is a clear acceleration. And think about it like a restaurant chain. If your restaurants are doing great, what do? You open new ones, you reinvest your profits, you even borrow, you raise money because you want to capture as much of that demand as possible. So when there's a huge demand in the cloud, of course, Google wants to make its capex bigger. As an investor, you'd want them to. But here's what bugs me. Google had access to the bond markets, so why raise equity instead of just issuing debt? It doesn't fully make sense unless they're going to issue debt as well. And I think they are. I think the capex is going to be so big that they're doing both. The other possibility is that they genuinely think that their stock is expensive and want to use it as currency. It's only about 2% of their market cap, but for a $4.5 trillion company, that 2% is a lot. And here's the thing. They already issued a ton of debt. Google went from basically no debt to over $85 billion of bonds in about a year. And then put 85 billion equity raise on top of that. So this isn't equity instead of debt, it's equity and debt. And it's not just Google, it's Amazon, Meta, Oracle. They all did huge bond deals too. The only big one not piling into bonds, I think, is Microsoft, and that's because they found it through leases instead. I just wanted to show you this meme. It's poking fun at the whole circular financing thing. The joke is that Nvidia lends OpenAI the money, so OpenAI can turn around and buy Nvidia's chips. It's funny because it's a little bit true. And it actually ties into one of Michael Burry's main arguments that Nvidia's accounts receivable is growing faster than its cash. And accounts receivable is just sales they've booked but haven't been paid for yet. So chips shipped, invoice sent, cash not in the door. But in 90 or 30 days, depends on invoice, it'll be. So it's basically like debt, you could say, but not really. Going back to Michael Burry, finally the bears are coming out of their caves. Michael Burry, for example, is saying again that we're in an AI bubble. I think Ray Dalio also said that recently, but never mind. He's saying that Nvidia's top 3 customers make about 64% of its accounts receivable, uh, which is true. It's based on Nvidia's filings. But his argument is basically the AI labs are a big part of cloud's growth right now. So if one AI lab or one hyperscaler decided to cut back, the hyperscalers would pull back, Nvidia stops getting paid, and because of all of the circular financing thing, everything crashes. And and you know what? He's right. If one of them stopped, it would crash. But first, nobody wants that. So nobody wants to stop, right? Second, right now, nobody is stopping. Everyone is spending more and more. Google is literally a $4.5 trillion company issuing shares to spend even more. I mean, that's almost unheard of. And yeah, it is a little bit scary. On Barry's thesis, he always points out to accounts receivable growing faster than revenue, uh, like real cash revenue, which is actually understandable. I mean, the growth is accelerating and the supply is constrained. So, of course, receivables run ahead. That's what always happens. Um, so there's also that there's a lot of leverage, which is true, and ROI is unproven. Uh, which is also true. Even some companies say, like Uber or Microsoft, say that the AI basically cost more than the engineers that were replaced by the AI, right? So uh, the point stands. The ROI isn't proven. Uh, but for me, the strongest counter is that cloud margins are going up. And if margins are rising, it means that the demand is real and it's not slowing. The cloud already had tons of existing customers, and right now they're willing to pay even more. Uh, but here's the one bear argument I can't fully shake, and it's why I'm a little bit cautious. It's that we don't actually know where cloud's growth is really coming from, and there are basically three sources. Uh, First, the AI labs themselves, so Anthropic and OpenAI. Uh, if most of the demand is them, I mean, that's a fragile setup because a lot of those labs are spending money they raise from venture capitals and through debt. So uh, it's not money they're earning. It's a closed loop. It's this whole circular financing idea. This, the same AI money getting passed around between a handful of players. And if that funding ever dries up, so if there's really a liquidity crisis, the demand dries up right along with it. All right. Second, is the hyperscalers own AI. So Google running Gemini and search recommendations and other stuff in its own cloud. Meta running its ads and recommendation models. And this one is actually fine because um, we can see actually the clear return on the spend. We see it in Meta's profits and in Google's core businesses. So it's okay, but you also have to be careful. And there's the first one, and this is the best case. It's if the real independent outside companies pay for this stuff. So that would be the durable kind of the demand because it doesn't depend on the hype cycle staying alive. The problem is we just don't know the split yet. So coming back to the sentiment, what I said before, a lot of bears are crawling out, and these are just some tweets I screenshotted. There's a lot of bearish stock out there, and honestly, that's good. We want to see some bears. It means that we're not in the peak euphoria yet. Okay, so before I give you my verdict on Google, let's take back and look at a few other parts of the market. So IREN, inflation, jobs, and Bitcoin. Then at the end, we'll come right back to Google and the whole AI trade. So some other news. IREN. I mean, who would have thought the ceasefires wouldn't hold? Who would have thought that, right? I mean, I'm not the best at the geopolitical stuff, so I won't go too deep, but the main thing is oil bounced back to mid 90s, so yeah, that sounds great. There's inflation chatter again. Inflation is above target. Uh, Recently, we've seen that a lot of that is energy, but core inflation is still above target too. So on top of that, the job market is still hot. Job openings jumped to about 7.6 million, the highest in almost 2 years. So between sticky inflation and strong labor market, the Fed has basically no reason to cut rates right now, and people are even starting to talk about rate hikes again. So yeah, that's not great. Now let's talk Bitcoin. Bitcoin is basically dead right now. We're supposedly in a bull market, but Bitcoin is down 45% from its highs. And nobody really knows why. There were some ETF outflows, Strategy sold 32 coins, but it's a short term. And also, these 32 coins is almost nothing, and we knew about it already. I mean, some people call it the Bitcoin cycle. I mean, maybe, but it feels off to me, you know. And here's what bothers me most: there are still so many people shouting that they're buying the dip. If I only saw bears, I'd be comfortable buying. That's what I do. If I saw bears, I'd be comfortable buying. Uh, but there are more deep buyers than bears right now, so I'm not buying right now. I'm not buying right now. I actually bought a little bit when it tried to break out, but now I'm waiting. I'm waiting, and I'm not touching it until I see either total surrender or a clean breakout. Until then, it just feels bad. So rest in peace to all of my fellow Bitcoin back holders. But let's talk about some bull cases I own. IREN. Finally, some good execution. Now I feel a little bit bad for having sold the shares. I mean, not all of the shares, but for taking some profits. Uh, they just closed a $3.65 billion of A-rated GPU financing, which is huge. It means the market believes in them. And it's about 6% a year, which is really cheap. They also picked up an 800 megawatts of capacity in South Australia, which is also great. Also, Nebius landed an 8 billion euro deal in France, and also Jensen praised them publicly during the Computex, so Nebius got a nice pump. And CoreWeave also has seen some nice news. It's the first to validate Nvidia's Rubin, which means they're first to sell it, which is huge. They also signed a 15-year Chicago data center lease, so they'll pay about 2.2 billion over its life, and that's bullish. It means that the demand is there, and they can ship capacity faster. So finally, some nice news. But let's go back to verdict. So overall, Google, am I buying or am I selling? I actually think it's bullish. I don't think they sold because they believe their stock price is too high. I genuinely think, and I genuinely believe in that, that they believe in the AI story. I think they believe in it. And I think the only reason they'd raise equity instead of bonds is that they're going to do both. And they're going to raise even more bonds and even more equity. And by doing this, Google just opened the gate for every other hyperscaler to also raise equity, fund more, and push capex. And growth even higher. It also got much riskier though, but you know, the reward also got much bigger. So, how do I play this out? I'm not buying Google right now. I think it drifts back. Let me show you the price on my charts. Where is Google? Oh, I think it drifts back to pre-earnings prices. Where is it? Here, 350. And maybe I'll pick up a few shares there. But you know, if capex is about to get much bigger, I think the best way to play this out is this company. It's Nvidia. Let me full screen it. I think Nvidia hasn't run nearly as hard as other semis, so yet it takes the biggest slice of all of this capex. It grows like crazy. You've seen it's 85% revenue growth. So yeah, it grows like crazy and it barely moved. So yeah, I'm buying Nvidia. I think it's the cleanest way to play this. And I hope it really plays out. I might actually also buy some SaaS companies as a small hedge to that. But yeah, I'm buying Nvidia. So that's it. Thank you guys for watching. Tomorrow I'll try to cover Rubrik's earnings. I think they report tomorrow. Thanks again, and I'll see you soon in the next videos. Bye.